that, then does it tell you that it's recording?
Now it does, yes.
Okay, cool. Okay. Welcome everyone back to the Passive Income MBA podcast. Today, I'm so excited to have Anthony Walker here with us. Anthony, great to have you on.
Thanks for having me.
Awesome. So everyone, Anthony is the CEO and managing broker of Buckingham Investments. Just as Buckingham Investments has been doing for over 50 years, Anthony seeks to be a trusted advisor and assist his clients with achieving financial independence and retirement security through investing in multifamily income property. He believes that real estate wealth is not created only at the time of purchase, but well before an investment is ever made through education and planning. So, Anthony, I'd love to start with you taking us back in time a little bit and telling us a bit about your background and how you got to where you are now.
Sure, happy to. So I got into real estate investing. My first investment property was actually 15 years ago now, hard to believe, in 2006. That was a vacation rental condo in Costa Rica. So I don't know if that really counts or not. But I was interested at that point. At that time, I was in a corporate insurance job that, paid the bills, but I was never really going to get wealthy or financially independent doing that. So I kind of liked the experience of looking at investments, but I didn't really know where to go with that. I wanted to transition careers out of working for a big company and into owning my own business of some sort. So I went to business school at night. And that, I guess I started in 2008. So I had pretty good timing. I did stay working at the time, which I was fortunate about because, we know what happened in 2008. And so I was getting my MBA while I watched the subprime crisis unfold and started buying properties here in Southern California, first in 2009, and then got introduced to Buckingham Investments in 2010 and started buying multifamily properties around then, which is really when I kind of committed to that as my core strategy, multifamily right here in Southern California. Since then, I was first a client of the company, then got my salesperson's license. I transitioned out of my corporate job into helping clients buy apartment buildings and sell apartment buildings and grow wealth. And then I was doing the same thing myself along the way. And now took the company over in 2017 as the CEO. The original founders are not doing as much anymore. And they just have a great business model all about teaching clients how to invest, how to grow wealth through real estate. And it's been a great complementary business for me to be a broker in the space, as well as adding to my own portfolio. So now, 2021, I am in escrow on my 16th building, more than 16 over the years, but I'll have 16 myself. I have about 120 doors, mostly in the Long Beach market. That's my favorite, but I do have some properties in other areas here in Southern California. And it's a lot of fun. Buckingham is growing. We've added quite a few agents over the last year, and we've cracked the CoStar top lists now in the LA market. So it's an exciting time to be working here.
Awesome. Well, one of the things I definitely appreciate about you and Buckingham Investments is that you're brokers, but many of you are also investors, and that's an important part of your own wealth building strategy. So much respect for that. And so, Anthony, recently you did a keynote presentation that touched on return on equity versus return on investment. And I'd love for you to give the listeners an overview of those concepts and why they matter.
Yeah, absolutely. So we meet a lot of people that, get exposed to real estate investing terminology and metrics and different ways to analyze deals all over the place, whether you're on podcasts or you're reading books or going to seminars. And a lot of people love to focus on ROI, right? Return on investment, which is on your original capital invested. But if you really think about it, real estate's about building long-term wealth, right? So once that first year is over, unless you're doing a flip or something where you're really just investing a specific amount of money, you're not really planning on owning a property for a very long time and you're just going to resell it. As soon as you get that past that first year of ownership, ROI is not a very meaningful metric anymore. If you're investing for the long term, it makes more sense as an investor to measure return on equity. And what I mean is every year, your equity is going to be different, right? Depending on the value of your property, minus your whatever loan you might have on it, right? So if you do well and you buy well and you add value and you increase rents, right, your equity is going to increase in the next year after you purchased. So if you look at ROI, you're going to look like you did great. If you look at ROE, it's helpful as well. And in a rearward looking direction, you can show how successful your investment was. But on a forward looking direction, what happens with ROE is that as the equity in that equation, which is the denominator, right, return on equity, as the equity grows, your ROE in your next forecasted year of growth is going to go down. And that's kind of a critical concept, because what that does is it allows you to analyze what you should be doing with your portfolio and optimize the leverage that you have in your portfolio at any given point in time. Kind of hard to illustrate without hopping on a board or a PowerPoint or something like that, but the basic concept is there, right? If you have $500,000 in $1 million deal and it goes up at 5%, then you've gone up $50,000, which is 10% of your 500 grand in equity, right? Whereas if you have $500,000 in a $2 million deal and it goes up by 5% from appreciation, you've made $100,000, which is a 20% return. So if you can manage to that future forecasted kind of average return that you're going to get, you're going to make better decisions rather than just patting yourself on the back because your ROI looks so good. Your ROI is actually going to get better and better and better every year, but it's not actually a very useful metric for making decisions for the future once you're past that first year. Hopefully that makes sense.
Yeah, it does. I think let's just break it down a little bit and go through a very basic example. So let's say somebody bought a house in 30 years ago, and now they bought it for maybe let's just say $300,000. It's 30 years ago. Now
Sure.
it's worth $1 million.
Right.
And so they paid off their mortgage,
Right.
and now there's $1 million worth of equity. And if they're getting, say, $4,000 in rent on $1 million of equity, that doesn't look as good as if it was, $40,000 on, maybe they just bought it outright at $300,000. That's what we're talking about here, right?
Well, somewhat, yeah. So you have your cash return on what you paid for it, which looks better and better. So if you bought it for 300,000 and now you're making $4,000 a month, that's like $48,000 a year. You got over 300,000. Your cash return on your investment is going to look really strong in that scenario, right? Because you're looking at a number from way in the past. Same thing with like your ROI from, let's say, appreciation during that time. If you spent $300,000 on a property and now it's worth, $1 million and you only put 75 grand down, then your ROI is over 1,000% over those 30 years because your 75 grand has grown more than 10 times, right? So great job, you did it, awesome. Well, why aren't I retired yet and enjoying the fruits of my labor? Well, the answer is because in the next year, if your house is paid off and there's $1 million in there and it's cash flowing $48,000 a year, you're making a 4.8% cash return on equity because there's no loan. And if it's appreciating at 5% as well, you're making another 5% from appreciation because $50,000 divided by 1 million. Those two together, you make 9.8% on your money. That's fine. But if that's all you have for your nest egg and you've still got 10, 15, 20 years left to work, it's not going to do anything more for you. That's going to grow incrementally at whatever the rate of inflation on the cash flow or the rent growth, plus the appreciation on the property. If you took the $1 million and instead you exchanged the property into a $4 million apartment, though, now we're talking, you can get a return on equity from appreciation of 20%. You can probably still get a cash on cash return of around 5% on that $1 million if you use the right financing and you buy the right property. That gets into like a cap rate discussion, and it's we would want to break out Excel and all that kind of stuff to get into that conversation. But you can easily get your returns on the same chunk of money up to 25% or so once you take leverage into consideration and you look at your next forecasted average year. So it's a good example.
Yeah, for sure. Yeah, thanks for carrying that through. And then one thing that we didn't quite mention also is that, well, if your house is totally paid off, then there's no mortgage interest to write off. So then it's all taxable income.
No mortgage interest to write off. And if you've owned it for 30 years, it's probably also fully depreciated.
Mm-hmm.
So you don't get any of the depreciation tax benefits. There's a lot of reasons to use appropriate amount of leverage investing in real estate. Using too much leverage can get you into a lot of trouble, as we all learned about 10 years ago, right?
Yeah, for sure. So I know you touched on this as like an option for folks like this who have um you had said potentially buying, exchanging into a $4 million building. What are some other options or considerations that you might have for investors in this position?
So if you have the house, you don't necessarily have to sell, right? You can do the math and do an exchange versus refi and buy analysis. And that's a really useful exercise to anyone that might be wanting to re-leverage but not really sure where to go. So if the house generates $4,000 a month in rent, then what you can do is you can do a max cash out refi pro forma. That's what we call it here at Buckingham. And you just figure out what market interest terms, interest rates, and payments are going to look like that are available to you, how much cash out you could take. On a single family, non-owner occupied, you can probably take out at least 70% cash out of the value. So you could probably get $700,000 cash in that scenario. But then the key question is that rent going to be enough to service the debt on the $700,000 loan you're taking out, and then use the $700,000 to say, go buy another investment property, whether that's an apartment building, which is what we like to do, or whatever, single tenant, triple net, or more houses, or medical office, or you name it. The most important part of that analysis is figuring out what the debt load the house that you want to keep can support. Mm-hmm. So generally, there's an inverse relationship between area quality and how much debt an asset is going to support, right? If your house is in, like, say, I'm going to pick on Manhattan Beach. Not that there are any $1 million houses in Manhattan Beach. Maybe there's a condo, right? But $1 million house in Manhattan Beach is the rent to the value differential there, which is a gross rent multiplier in the apartment space, is going to be so high, you're probably only going to be able to put about 30 to 40% loan to value debt on that property before it starts losing money every month on an operating basis. So if that's the case, you're not able to re-leverage the property you already own very well. And that's an indication for maybe a trigger for you to consider doing an exchange instead of a refinance and buy. Whereas if you say own an apartment building that is already, a 5% cap rate, that's probably going to support a 75%, 75% cash out refi, still cash flow afterwards, and allow you to use the proceeds to go buy something else. So that would be something you don't necessarily need to consider exchanging. But that's sort of the analysis that you'd want to do if you had that type of asset.
And what sort of debt service coverage ratio would you recommend if you were talking to an owner? Like if they were going to refi, I mean, would you recommend like a 1.25 or something lower than that? I'm sure it depends on how deep the pockets are. But
sure. I mean, it's to everybody's individual risk tolerance, really. I mean, a good baseline to use is what lenders are going to do. So, lenders in our area are going to loan to a minimum of a 1.2 debt coverage ratio. So for those who don't understand, that's the net operating income a property generates divided by the annual debt service. So the lenders want you to have a 20% pad on top of your net operating income and paying for the mortgage. They're going to force you to cash flow, basically. I think that's a great, kind of baseline to go off of. If it's, if lenders are comfortable enough loaning you money under those circumstances, you should probably be perfectly happy to own under those circumstances. On the other hand, if you have a 1 to 4 unit building, the way that they do underwriting is, more based on your individual income scenario, and they will let you go negative or to a 1.0. So, everyone's at a different point in your life. If you're still working and you've got a high income situation in your active job, maybe it makes sense to take it down to a 1.0. So the property just pays for itself and that unlocks more cash. That's going to allow your ROE probably to be higher because you're using more leverage on the property you already own. And it's going to unlock more cash for you to buy a larger building for your up leg, so to speak, or your new purchase and use a maximum amount of leverage there too. Everybody just has, different preferences, but, a 1.2 is probably a great baseline to start with if you're just kind of contemplating this idea.
Awesome. Yeah, that's super, super helpful. So one of the things I also love about you, Anthony, is that you invest in SoCal when it seems like pretty much everybody else or most other investors are focused on the Sunbelt states and the Southeast, et cetera. So I'd love to hear from you what it is that's compelling to you about investing in SoCal, why almost your entire portfolio is in SoCal, and why you think it's a good place for investors to look.
Absolutely. I know this is an unpopular opinion in the syndicated real estate space, but fact of the matter is there's still billions of dollars in trades happening here in our market. This is one of the best markets in the country to be involved in. And to give you my totally biased opinion and support for it, I'm always happy to. Um, I look around at what the other options are, and I have invested out of state before. And it really comes down to a supply and demand imbalance, in my opinion. So, when you look at SoCal, we have 10 million plus people here, not enough land for everybody to live in. Obviously, that creates, homelessness problems and affordability issues, and we can get into all that kind of stuff. But really, at the end of the day, if you think about it, we've got mountains on to the north, and then we have ocean to the south and the west, and then we have 100 miles of city to the east, and basically no significant amount of land where developers can add a lot of supply. Certainly not in the class B and C space, which is where I do a lot of my business. Yeah, they're building class A towers and stuff like that, but the tenants for those things are not. They're not in competition for our tenants for the same space. And on top of that, we're short, over 500,000 units that are demanded by the current people that are here. So when you have a constraint on supply because there's not enough land, and a ridiculous amount of demand because we're the third most productive metropolitan economy in the world, over $1.05 trillion. Third only to Tokyo and New York City. And when you look at prices here, it's just a really compelling argument, especially if you're investing for the long term like I am. Now, a lot of the stuff that I'm buying, like, I love Long Beach, so I talk about it all the time. But Long Beach, you can buy apartments for a 4.5 to 5 cap rate, 10 blocks to the Pacific Ocean, which is a plenty good cap rate to take advantage of some really good leverage. And I think the long-term prospects for value there are just insane. You're in a super diverse economy. You're in a dense urban area in Long Beach. You've got a great job base around it. And no, the population is not growing right now, but we have plenty of people and not enough space to house them. And we keep getting higher paying jobs that come in here, whereas we are losing some of the lower income residents. You contrast that to something, like one of these other markets where I'll talk to syndicators or people that are investing out of state in the popular states, southern, southeast states, Sunbelt states, and they're buying 5 caps. And to me, if I can get a 4.5 cap, 10 blocks to the Pacific Ocean, it's not worth the cost of a plane ticket and building a whole new team of people to go out and do that somewhere else. That just doesn't make sense to me. Combine that with the fact that the buildings are just expensive here; they're worth a lot. But because of that, if your price per square foot is super high, there's not a whole lot to the real estate, the physical real estate, right? Like a 4-unit apartment building is 3,000 square feet and it's worth $1.2 million. It's pretty typical building. And there's very little to this building. It's got a flat roof that you can probably replace for $15,000, which is a tiny proportion of the purchase price. It's got gas wall heaters, no air conditioning, might be 100 years old and so on and so forth. But these buildings are pretty easy to maintain. They're not very large. So expense ratios tend to be really low relative to the income. And then when you're, buying stuff at 14, 15 times gross, your ability to add value is also amazing because every dollar of rent adds $14, $15 in value to the property. So combine that with, tier 1 best financing available in the country, and you have a pretty compelling argument, I think.
Awesome. Yeah, that's yeah, it's definitely somewhat of a contrarian viewpoint to what we normally hear, but it's very compelling when you lay it out, Anthony. So I also want to touch on working with brokers. So you're a broker, and a lot of syndicators are looking for properties. They want to, we know we need to build relationships with brokers. And it's a skill that needs to be developed. So I'd love to hear your take on your recommendations, advice, thoughts for our listeners.
Yeah, absolutely. Happy to share on this one. You see a little bit of everything out there in the market when you're a broker, and everybody approaches deals a different way. And it is something you should learn. If you're trying to enter a market, it's gonna be tough at the beginning if you don't have your relationships in place. And there's a right way and a wrong way to approach people. I can't tell you how often I get this phone call, right? Somebody calls me up and they say, hey, are you Anthony? Yeah. Okay, you're a broker in this space? Yeah. Okay. I want 5 and up apartment buildings with a 40% upside in rents. I'm only interested in off-market deals, and just send me all your off markets. It's like, okay. Yeah, that's not going to get you to the top of the list, because these deals are not that common, right? Like there's occasionally really good deals that will work for a lot of people's criteria, but as a broker, you have to, we don't get paid a cent until our principal closes on a deal, whether you're a seller or a buyer, and your ability to perform is going to be what gets the repeat business from the broker. We put a lot of work into these deals. We put our relationships on the line to make these deals happen. And so, when we do have an off-market deal that's really compelling, it's not usually going out in an email blast to everybody we know, right? Because that's just going to create chaos. It's going to create people trying to circumvent you, and you're trying to add value to a transaction and, frankly, get paid, right? So, what's going to happen in that scenario is the broker is going to call the people at the top of their list, probably usually the people who have performed before first, to be honest. So, getting that track record established with your first deal is probably the most important thing. But then after that, the people that the broker feels like they like, that's not going to take advantage of them, that's going to be straightforward, transparent, where we can understand exactly what you're looking for out of a deal. There's a lot of people that go around, just trying to lock up everything they can into escrow and then figure out the details later on whether the deal makes sense for them. That's a great way to not get another deal from somebody if you're, really known for having a lot of cancellations or retrading. That's the worst. If you know what that is, that's, asking for a giant reduction or credits after you're in escrow. And that was, the point to begin with, right? So just bad form in general. And I think a lot of people are short-sighted about doing that type of thing. But if instead you reach out and you explain, look, this is my platform, these are who my investors are, this is the relationships I have with them, these are the decision makers that are present. Nobody likes to be surprised with a whole bunch of decision makers we didn't know about when we're trying to put a deal together. Here's my financing structure. If you can help us understand what you're looking to do, we can help find deals that actually are going to work for your criteria and your platform, instead of just saying, oh no, just send me your best deals. I only want to buy at 175 a door, which is just not possible, by the way, unless you're buying tiny studios in rough neighborhoods. It just makes our job a lot easier, and we're going to be able to triage the right deals to you. And then if we know about you, we're going to be able to know in advance that you're likely to be able to close, which allows us to go to the principal on the other side of the transaction or the broker on the other side of the transaction, because often that's the relationship at play, and explain the whole story. And then you get a comfort level, and then you get to use our track record with everyone else in our market to get your offer accepted. So there's a lot of value there. A lot of people like to say, well, I'm just going to call listing brokers and then get the deal. I cannot tell you how many times I've seen that not play out. If people had called a good, agent that does a lot of buy side rep like we do. I won a deal last week against somebody who I know was being represented by the broker on both sides, and the broker chose us because he was confident we were going to be able to close based off of our previous relationship, rather than the random person who had called him from LoopNet and was trying to get the deal done. You would think that works every time. It doesn't necessarily go that way. So establish those relationships up front before you ever really need somebody. Loyalty goes a long way. Make sure you relist your properties with the person who sells them to you, and you're going to get more deal flow that way. If you act transactionally, or if you try and pinch pennies or nickel and dime, or take from everybody in the chain of the transaction out of their pocket, that's a great way not to get more deals.
Awesome. Well, thanks so much for schooling us on that, Anthony. It's definitely important for anyone in this business to learn how to build solid relationships with brokers and have excellent deal flow. So thanks. So now I'd love to just, before we wrap up, take a minute to shine the spotlight on you. I know you do a great job of bringing investments to investors at Buckingham. Just tell the listeners how they can get in touch with you and anything you'd like to share.
Sure. You can check us out on our website, buckinghaminvestments.com. We have tons of free educational materials, videos, seminars, podcast appearances, guides and books you can download. And then, of course, you can book meetings with our staff directly on our website. If you want to reach out to me, my email is anthony.walker@buckinghaminvestments.com, or I'm sure you can find me on LinkedIn as well.
Awesome. Well, we'll make sure to have links to all those in the show notes. Thanks so much again, Anthony. We'll see you next time.
Awesome. Thanks for having me.